Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 19th of February. It's been a week dominated by inflation and interest rate expectations. There was a stubborn US inflation print early in the week which threatened to upset the apple cart, but it seems now that investors are coming to realise that perhaps there aren't going to be 6 rate cuts in the States this year, and indeed the consensus for the first cut has now been pushed back probably to June. That being said, there has also been renewed buying interest in the US mega-cap technology stocks, which has obviously put something of a foundation under the Nasdaq. In the UK, we also got news that we'd entered a shallow recession at the end of 2023, although market impact was limited, not only in terms of the undemanding valuations of the market at the moment, but also, of course, the news that was at the end of 2023, rather akin to driving in the rearview mirror. So, in the year to date, the Dow Jones is currently up by 2.9%, S&P 500 by 5.5%, the Nasdaq up by 6%, and the FTSE 100 is trailing behind and down by 1%. Turning to next week, it's all about banks. NatWest kicked off the reporting season on Friday in some style, although it had an initial wobble, and the rest of the UK banks report next week. There's going to be any number of themes to look out for all of them. That's the likes of net interest margin, net interest income, the capital cushion or CET1 ratio, the return on tangible equity, and of course impairments for any signs that there's a weakness in customer defaults and loans. By the same token, shareholder returns will also be in focus, the likes of dividends and buybacks. So quickly going through, Lloyds obviously has its full year numbers, share price down about 21% over the last year, dividend yield of 6.1%, tends to be a sector beating cost income ratio, so that's one to keep an eye out on as well. It's also seen to be something as a barometer of the UK economy, hence part of that weakness. And we'll also be looking out for any updates on its digital progress. Barclays down about 17% over the last year, dividend yield 5.4%. Specific to Barclays, it will be worth looking out for number one, its investment banking unit and any deal-making fees improvement, and also US credit card spending and whether the US consumer is starting to feel any strain at all. HSBC up 2% over the last year, dividend yield 6.7%, and Standard Chartered down by 21% over the last year, dividend yield 2.7%. Obviously for both of these, there's a big Asia focus, and China in particular, where there's already been some hurt regarding the real estate sector, so updates will be welcome there on both. For HSBC as well, there will probably be some sort of updates on its recently launched Asian wealth businesses. Quite apart from the banks, there's also full year numbers coming from the likes of BAE Systems and Rolls-Royce. Thank you for watching. Have a great week.